Look, something extraordinary is happening right now in the financial markets, and most people have absolutely no idea it's even taking place. While everyone's distracted by stock market headlines and crypto volatility, the largest wealth transfer in modern history is quietly unfolding. And here's the thing that should terrify you. This transfer isn't random. It's deliberate. It's systematic. And if you're not positioned correctly, you're going to be on the wrong side of it. Let me paint you a picture of what's actually happening behind the scenes. Central banks around the world are buying gold at a pace we haven't seen in over half a century. We're talking about massive accumulations. The National Bank of Kazakhstan alone added significant reserves recently. Poland's been stacking. China's been buying month after month. India's central bank is accumulating. Turkey, Singapore, the Czech Republic. The list goes on and on. These aren't small purchases either. We're looking at hundreds of tons per quarter being absorbed by official institutions. Now, why does that matter to you? Because central banks don't do anything without a reason. These are the most informed players in the global financial system. They have access to data you and I will never see. They understand currency flows, debt dynamics, and geopolitical risks at a level that would make your head spin. And right now, they're all moving in the same direction. They're converting paper assets into physical gold at an unprecedented rate. Think about what that tells you. These institutions literally create money out of thin air. They can print their own currencies, yet they're choosing to exchange that paper for heavy metal bars that sit in vaults and generate no yield. Why would they do that unless they knew something fundamental was about to change in the global monetary system? Here's where it gets really interesting. While central banks are aggressively accumulating, there's another group doing the exact opposite. Retail investors, pension funds, and everyday people are sitting in bonds, cash, and paper assets that are being systematically devalued. The wealth isn't disappearing, it's transferring from those who don't understand what's happening to those who do. Let me give you a specific example of how this works. Imagine you're holding $100,000 in a savings account right now. You think you're being safe and conservative. But here's the reality. That money is losing purchasing power every single day. Not just because of the inflation rate they tell you about, which is bad enough, but because of the real inflation you experience when you buy groceries, pay rent, or fill up your gas tank. Your $100,000 buys less and less with each passing month. Meanwhile, someone who converted that same $100,000 into physical gold several years ago has watched their purchasing power not just maintain, but expand dramatically. Gold has hit record highs in virtually every major currency. It's not that gold became more valuable. It's that the paper currencies became less valuable. Gold simply maintained its purchasing power, while everything else declined. But here's what most people miss. This isn't just about inflation protection. This is about a fundamental restructuring of the global monetary system. For decades, the world has operated on a dollar-based reserve system. Countries held dollars. They traded in dollars. They priced commodities in dollars. That system is breaking down right before our eyes. The BRICS nations are actively working to create alternative payment systems. They're settling trade in their own currencies. They're establishing gold-backed mechanisms for international commerce. Saudi Arabia is now accepting yuan for oil sales. The United Arab Emirates is trading in rupees. The entire architecture of global finance is shifting, and gold is at the center of that shift. You want to know why? Because gold is the only asset that's nobody's liability. When you hold a dollar, you're holding a promise from the US government. When you hold a euro, you're trusting the European Central Bank. When you hold any paper currency, you're dependent on the issuing authority maintaining discipline and credibility. But when you hold gold, you hold an asset that's been recognized as money for 5,000 years. It doesn't depend on any government's promise. It doesn't require any institution's backing. It simply is. Now, let me tell you about something that happened back in the early 70s that's eerily similar to what we're seeing today. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. At that moment, the entire global monetary system changed. Countries that had been holding dollars suddenly realized they were holding paper that couldn't be redeemed for anything tangible. What happened next? Gold went from $35 an ounce to over $800 within a decade. That's not a 20% gain or a 50% gain. That's a 2,200% increase. The people who understood what was happening and positioned themselves in gold before that transition became extraordinarily wealthy. The people who stayed in cash and bonds watched their purchasing power evaporate. We're at a similar inflection point right now. The difference is, this time it's not just the United States making a unilateral decision. This time, it's the entire global system recognizing that the current arrangement isn't sustainable. The debt levels are too high. The money printing is too extreme. The trust is too eroded. Something has to give. And here's the part that should really get your attention. The physical gold market is tiny compared to the paper gold market. When you look at the COMEX, the London bullion market, all the gold ETFs and derivatives, there's hundreds of times more paper claims on gold than there is actual physical metal. It's like a game of musical chairs where there are 100 people but only one chair. What happens when people start demanding physical delivery? What happens when investors realize that their paper gold certificates might not be backed by actual metal? What happens when the countries holding dollar reserves decide they want something more tangible? You get a squeeze. A massive system-breaking squeeze where the price of physical gold disconnects entirely from the paper price. We're already seeing early signs of this. Premiums on physical gold coins and bars have been elevated for months. Delivery times are extending. Refineries are running at full capacity. The U.S. Mint has had to ration production of gold eagles. These are not normal market conditions. These are the conditions you see when physical demand is overwhelming available supply. Let me tell you about what's happening in the silver market too, because silver is gold's little brother, and it's setting up for something even more explosive. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and countless other technologies. The industrial demand alone is consuming more silver than is being mined. But here's the kicker. The above-ground stockpiles of silver have been declining for years. We're mining about 800 million ounces annually, but we're consuming over 1 billion ounces when you add up industrial use, investment demand, and jewelry. That deficit has to come from somewhere, and it's coming from existing stockpiles. Those stockpiles are finite. They're running down, and when they're gone, the price is going to have to rise dramatically to either reduce demand or incentivize more production. The gold-to-silver ratio right now is historically extreme. Throughout most of history, that ratio has been somewhere between 15:1 and 50:1. Right now, it's hovering around 80:1. That means you can buy 80 ounces of silver for the price of 1 ounce of gold. When that ratio normalizes, and it always does eventually, silver is going to outperform gold by a massive margin. Think about what that means for someone positioning themselves today. If you're buying silver at these levels, you're not just getting a monetary metal that's going to benefit from the same forces driving gold higher. You're getting a metal that's also going to benefit from a ratio reversion that could double or triple your relative gains. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand that there are ways to get physical gold into those accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs actually work. It's completely free, and you'll find it in the description below. It covers the mechanics, the rules, the custodians, everything you need to know. If protecting your retirement savings is a priority, it's worth taking a few minutes to check that out. All right, back to what's happening in the markets. Let's talk about the mechanics of how this wealth transfer actually occurs. It's not like someone's going to knock on your door and take your money. It's much more subtle than that. It happens through currency debasement. It happens through inflation. It happens through the slow, steady erosion of purchasing power that most people don't even notice until it's too late. Here's a real-world example. Let's say you retired 20 years ago with $1 million in bonds. You thought you were set for life. That $1 million generated maybe $50,000 or $60,000 a year in interest, which seemed like plenty at the time. But what's happened since then? The cost of everything has gone up. Healthcare is more expensive. Property taxes are higher. Food costs more. Energy costs more. That $50,000 doesn't buy what it used to. Your nominal wealth stayed the same, but your real wealth, your purchasing power, declined dramatically. Now, compare that to someone who put even a portion of their retirement savings into gold 20 years ago. Gold was trading around $300 an ounce back then. Today, it's over $2,000. That's not just keeping up with inflation. That's dramatically outpacing it. That's wealth preservation in its purest form. But here's what most financial advisors won't tell you. They'll say gold doesn't generate income. They'll say it's a barbarous relic. They'll say you should be in stocks and bonds and real estate. And you know why they say that? Because they can't charge you management fees on gold sitting in your safe. They can't generate commissions on gold you buy and hold. Their entire business model depends on you staying in the traditional financial system where they can extract fees year after year. I'm not saying you should put everything into gold and silver. That would be foolish. But I am saying that if you have zero exposure to physical precious metals right now, you're taking an enormous risk. You're betting that the current monetary system is going to continue functioning exactly as it has. You're betting that central banks are going to maintain discipline. You're betting that governments are going to control their spending. You're betting that the dollar is going to maintain its reserve currency status indefinitely. Those are big bets. And the people who understand the system best, the central banks themselves, are betting the opposite way. They're accumulating gold as fast as they can. They're diversifying away from dollar reserves. They're preparing for a different monetary reality. Let me tell you about what happened in Weimar Germany in the early 1920s. People think hyperinflation happens overnight. It doesn't. It's a gradual process that accelerates. At first, prices go up a little bit. People notice, but they adjust. Then prices go up more. People start getting concerned. Then suddenly, it's exponential. People are carrying wheelbarrows full of cash to buy bread. Life savings are wiped out in weeks. The people who survived that crisis were the ones who got out of paper currency early. They converted their savings into hard assets. Gold, silver, real estate, anything tangible. The people who stayed in cash, who trusted the government's promises that everything would be fine, lost everything. Now, I'm not saying we're heading for Weimar-style hyperinflation tomorrow, but I am saying the conditions are being set for a significant devaluation of paper currencies. The debt levels are unsustainable. The U.S. national debt is over $34 trillion and growing by trillions every year. The interest payments alone are becoming unmanageable. At some point, the only way out is to inflate the debt away. That means printing more money. That means currency debasement. That means your savings lose value. Gold and silver are the antidote to that. They're the assets that maintain purchasing power when currencies are being debased. They're the assets that central banks turn to when they lose faith in each other's paper. They're the assets that have preserved wealth through every monetary crisis in human history. Here's another thing to consider. The mining supply of gold is actually declining. We're not discovering major new gold deposits like we used to. The easy gold has been found and mined. What's left is deeper, harder to extract, and more expensive to produce. The all-in sustaining cost for many gold miners is now over $1,300 per ounce. That puts a floor under the gold price. It can't go much below production costs for long without mines shutting down, which would reduce supply further and push prices back up. Silver has the same dynamic, but even more extreme. Silver deposits are often found alongside other metals like copper or zinc. When those base metal prices are low, silver production as a byproduct declines. We're seeing that now. Primary silver mines are struggling with costs. Byproduct silver production is down. Meanwhile, demand from solar panels alone is consuming hundreds of millions of ounces annually and growing. The supply-demand fundamentals for both metals are incredibly bullish. But the real driver, the thing that's going to send prices to levels that seem unimaginable today, is the monetary aspect. When people lose faith in paper currencies, when they realize that their savings are being systematically devalued, they're going to rush into the only assets that can't be printed: gold and silver. We saw a preview of this in 2008 during the financial crisis. Gold went from around $700 to over $1,900 in just 3 years. Silver went from $9 to nearly $50. That was just a crisis of confidence in the banking system. Imagine what happens when there's a crisis of confidence in the currencies themselves. The smart money is already positioning. Billionaire investors are allocating significant portions of their portfolios to gold. Hedge funds are taking large positions in mining stocks. Family offices are buying physical metal and storing it in private vaults. These aren't dumb people. They're not making emotional decisions. They're looking at the same data you and I can see, and they're drawing the logical conclusion. The wealth transfer is happening whether you participate or not. The question is, which side are you going to be on? Are you going to be one of the people who stays in paper assets and watches their purchasing power erode? Or are you going to be one of the people who recognizes what's happening and positions themselves accordingly? Here's what I want you to understand. This isn't about getting rich quick. This isn't about speculation or trading. This is about wealth preservation. This is about making sure that the money you've worked your entire life to accumulate doesn't evaporate in a monetary reset. This is about being on the right side of the biggest financial shift of our lifetime. The central banks know what's coming. That's why they're buying. The billionaires know what's coming. That's why they're allocating. The question is, do you know what's coming? And more importantly, are you going to do something about it? The time to act is before everyone else figures it out. Once the general public realizes what's happening, once there's a rush into physical gold and silver, the premiums are going to explode. The availability is going to dry up. The prices are going to gap higher. You want to be positioned before that happens, not after. Think about it this way. If you're wrong and gold and silver don't go significantly higher from here, what have you lost? You've got a tangible asset that's held value for thousands of years. You've got insurance against monetary chaos. You've got something you can hold in your hand that no government can print more of. That's not a bad worst-case scenario. But if you're right, if this wealth transfer accelerates the way all the evidence suggests it will, you're going to be positioned in the assets that benefit most. You're going to preserve and potentially grow your wealth while others watch theirs disappear. You're going to be on the right side of history. The signs are everywhere if you know where to look. Record central bank buying, declining mine production, massive paper-to-physical ratios, currency debasement across the globe, geopolitical tensions rising, debt levels spiraling out of control. These aren't random events. They're all connected, and they're all pointing in the same direction. I've spent years studying monetary history, market cycles, and precious metals. I've seen how these patterns play out. I've watched wealth transfer from those who don't understand the game to those who do. And I'm telling you, right now, at this moment, we're at the beginning of the biggest transfer yet. You have a choice to make. You can dismiss this as fear-mongering. You can trust that the system will somehow fix itself. You can believe that your paper assets are safe, or you can look at what the most informed players in the world are doing and follow their lead. The central banks are buying gold for a reason. The billionaires are allocating for a reason. The smart money is positioning for a reason. They see what's coming. The question is, do you? And more importantly, what are you going to do about it? This is your moment. This is your opportunity to be on the right side of the biggest wealth transfer in modern history. Don't let it pass you by.